Let's talk about Minda's Q4 performance. The company reported largely an inline set of Q4 earnings. Switches lighting segment continued to see growth of more than 20%. Management expects business to grow more than 1.5 times the industry growth rate. To talk about the performance, Sunil Bohra, Group CFO of Minda, is now with us on the show. Thank you very much for joining in. While margins are still on the whole within your guided band of 11% plus or minus 50 basis points, in Q4 there was a drop of 100 basis points in your margins. What led to that? And do you think you can increase what's the guidance on margins going ahead? Do you think there is scope to, for margins to cross 12% in FY26?
Yeah, so first, you mentioned that from year-to-year perspective, there is a margin softening of almost 80 basis points. And that is primarily because in the last Q4, we had some good price settlement with some of our customers which were delayed. But as we have guided, our overall profits have been within the range of 11% plus minus 50 basis points. And that's the guidance we are maintaining for FY26 as well. The key reason being, even though we are expecting growth and we are not able to see the benefit of operating leverage in our bottom line, is primarily because we are in a very high growth phase. We have multiple plants, businesses which are under startup phase or under phase where they are in the construction and will come into operation phase in the next fiscal year. So as you know, any new business or any new plant we start, normally you will have a lot of startup costs, and initially you are into ramp-up phase. So first year or two are actually in the investment phase where you don't get any returns. In fact, first year you might be actually in negative zone, but gradually you ride the growth phase, and once the plant stabilize, our target always has been in the third full year of production, we should achieve our guided profitability or targeted profitability. So that 11% plus minus 50 basis points actually factors in all those startup costs and initial ramp-up costs, and despite that, we are able to hold on to our margins. So if you exclude that, actually we might be improving our profitability if you see on apple-to-apple basis.
Hi, Mr. Bohra. Good morning and good to see you in. Nigel on this side. Well, India and UK, they have recently signed those FTAs. And even India as well as the US are likely to announce at least the first part of the bilateral trade deal. You have talked about additional opportunities, right? Do you see signs of that? And could that be a potential benefit for your company from the UK-India FTA?
Absolutely, Nigel. From UK-India FTA, as of now, we have not been having any significant exposure to UK. But we do hope as things stabilize, as the taxes comes down, we should gradually become more competitive. But coming to India-US, we have good exports, even though it's overall pie, it's not very high. Our revenue from US markets is less than 2% of our total revenues. But we do remain optimistic. We are seeing positive traction, discussion with our customers. And we are cautiously optimistic in terms of the discussions going on between the two nations. And hopefully whatever we are hearing from the government in US or the officials from the US, there seems like the auto component sector or the tier 1 sector might get good relief for imports into US. So from that perspective, we are seeing very good traction, and the discussion with our customers are in a positive zone in terms of maybe increasing our businesses as we move forward.
Sunil, hi, morning, Prashant here, and good to speak with you. You can't put numbers. It's too early, right? You can't put any numbers to it in terms of what it could mean. Volume of business going up. It's too early.
It's little early, but Prashant, I can tell that even in the current phase, before this 90-day pause, obviously we have been in discussion with our customers, and the feedback we have been getting from customers was positive in terms of the business continuity and expansion of that business also. We are in the process of evaluating few more RFQs which customers have issued to us. So hopefully as we move forward, in absolute terms, the revenue from that region, we do expect to go up. Yes, it is tough to put numbers on the table today, but we don't see any significant degrowth from that perspective. In fact, if at all, we are looking at upside only as we move into the near future.
What about Europe? That is UK, but what about Europe? I think here there are still headwinds, right? Cheaper imports, higher production costs, and of course, generally, it's just been a sluggish demand environment, region-wise.
No, you are right, Prashant. Region-wise, the volumes are significantly lower. So we have like both sides of the coin. We have a couple of key businesses there, one in Spain and one in Germany. So the Spanish business obviously is a horn business which is facing challenge because that is directly linked to the vehicle volumes. Though even though we have not lost any share of business, the volumes are significantly down, and that is what is showing up in our numbers as well. So like last quarter, our revenue from those operations is down by almost 25 crores in the quarter. But in Germany, things are looking better. Even though the volumes are down, we are looking at some new businesses which we feel will be able to more than offset the volume drop or the impact of the volume drop. So as of now, it's industry-wide. If you see, yes, volumes are lower, but we are looking at optimistically in terms of new business additions.
Sorry, what's the contribution of Europe and what's the extent of pressure?
Yeah. So in terms of revenues from Europe, from our Clarton Horn subsidiary, is something around 400 odd crores of revenue, and same broadly number is from the German business. And in terms of volumes, the volumes are down almost like 10 to 15%, which is what is mirroring in our Clarton Horn revenues.
Okay. Can you give, Sunil, some more color on your various divisions like switches, lighting, castings? What is the growth that you anticipate? What are the trends that you're seeing for FY26?
No, you are right. So if you see, a lot of our businesses do continue to ride on the premiumization theme. If you start with switches, we continue to hold on to our lion's share in both the businesses, be it the four-wheeler switches or two-wheeler switches, both in more than 50% market share. We are seeing a lot of upgradation in the switches, be it the haptic-based switches, touch-based switches, a lot of premiumization happening in that. We are also gradually increasing our share of exports into those businesses. If you see alloy wheel, yes, alloy wheel last year has been, in terms of application ratio, has been almost stable. So application ratio, when we say it is like alloy wheel versus steel wheel. So it has been almost in between 40 to 45% range for last couple of years. But globally, if we see, it is more than 85%. So India obviously will ride that journey, but it might not be in a short time frame. It might take a few years. But maybe last year was our consolidation phase. And in terms of tool alloy wheel, we have consistently been expanding our capacities in line with what we have done in four-wheeler wheel. Two-wheeler wheel, we have grown from 6 million wheel now to 8 million wheels, which is fully operational and fully booked. We have announced another 1.5 million wheel capacity in Bawal. So we are expanding our capacities, and there is a good demand we are seeing in the alloy wheel segment. Moving to some of the other segments like lighting, you said lighting has been one of our very strong growth area, which we have been able to successfully increase our market share in last couple of years, specifically in four-wheel lighting. Even in two-wheeler lighting, we are almost like 30% market share. So things are looking much better, and there is a lot of focus on innovation, technology, R&D, etc. In fact, recently we have also opened a new tech center in Czech Republic to support our four-wheel lighting business. So there is a lot of action happening on all that. And if you see from growth perspective, and our target has always been to do at least 1.5x of the industry growth. And if you see last year, we have done industry grew over by 9%, we grew by 20%. So that clearly demonstrates our commitment, and we do hope that as we move forward, we should be able to deliver at least 1.5x of the industry growth based on all these factors which I just spoke about.
Okay, all right, Mr. Bohra, very quickly, before we let you go, could you tell us what's the current content per vehicle? What's the difference between, say, an ICE as well as an EV? And where do you see the content per vehicle number headed?
So content per vehicle, if I see broadly in the two-wheeler segment, currently stands roughly around 12,000 rupees for ICE and roughly around 35 to 40,000 rupees for an EV two-wheeler. And in terms of PV, it ranges very, very widely. So if you see, it is for the top end almost like 2.25 lakh for a D segment car for ICE engine, and for EV, you can add another roughly 1 to 1.5 lakh rupees of kit value on top of that.
All right. We have Sunil, thank you very much. I think that's a fair bit of detail, and look forward to our next conversation. Thank you indeed for joining us.